Hey everybody, Lawrence from financialthing.com. It's the weekly Thursday afternoon, morning, evening, Friday, wherever you are. Welcome. Thank you for joining. Happy to be here again. Harley's back there, snoozing in her bed as usual, being super helpful. I hope you're having a great week. We are talking today or this evening for you in the UK. We'll talk some peer-to-peer lending today. It's a bit of a light news week. Not really much going on exciting, but some interesting news articles that came out. At least I found them interesting. And we're going to talk about, one second. I'm going to talk about some of the reasons why, as a result of an article that came out, the reasons why I'm really still bullish on peer-to-peer lending, and some of my personal reasons for continuing to really stay involved with the industry and the sector, and why I like peer-to-peer lending still. You know, even though things have happened that have made us fall out of favor in some terms, I still think it's a good industry and sector. Again, just my opinion. And you should never, ever, ever take financial advice from somebody on the internet, on YouTube. But you can certainly listen to opinions. I think that's a better way to do it. We're going to talk about some stock stuff too, about what is going on with this bipolar stock market that just can't seem to make its mind up with what it wants to do, why it's doing that, and what we can expect. We'll talk about the Trading 212 portfolio and kind of take a look at our trackers too and see how those have performed over the last couple, 3, 4, 5, 6 years, and where you might want to look to put some money to get some decent returns. So if you can just do me a favor, hit that thumbs up. If you're watching in the future, thank you for watching. Appreciate you subscribing to the YouTube channel and for being here. As always, we do have a guest in March. Say that again. Folk to Folk is going to be here, and they are going to tell us all about what's going on over at Folk to Folk, peer-to-peer lending company. We've never had it on the stream before. It's going to be the first time since ever. I mean, 6 to 7 years I've been doing this. So it's going to be interesting to talk to Folk, see what they are up to. Let's have a quick hello to everybody on the stream. Let's see who we got here. Patty is in France, 61 minutes early to make up for last week. I expected more from you, Patty. I was expecting 120 minutes early. Lionfish hunting in Grand Cayman, weather is 30 degrees centigrade today, 24 C overnight. Very nice. Yeah, it's like that here in Orlando, very hot. It's a little bit disgusting, actually, at the moment. A little bit too much, but it is what it is. No snow, no rain. John Day, hi from Nottingham in the UK, not too hot. I'm going to be drinking a lot of water today because my voice is still a little bit crackly, so forgive me. Paul Bagworth in Kenilworth. Colin Perry in the Peak District. J.M. Roberts in Toronto. Trust Lawrence is all well tonight. I'm alive and breathing. J.M., thank you so much for your care. I appreciate that. Stephen Hale in a getting cold in Nottingham. Alan is here in Worcestershire, as they say in the US. Worcestershire, as they say in the UK. Expecting below 0 tonight. Ugh. Actually, I wouldn't mind some below 0 right now, I tell you. Peter in Leatherhead, Grey Cool Damp, Alan Toombs in Basingstoke, Annabelle Naira, and of course in sunny Spain, hopefully. Buenos tardes, good evening to you. Lawrence, lots of buffering. Yeah, I don't know. My internet has been kind of weird over the last couple of weeks. I got to get it looked at. Something to do with my Wi-Fi. Hopefully you can see me. Maybe it's your internet that's wrong, but I am here. So hopefully everything is all good. We are broadcasting on YouTube and Facebook today. So let's get right into it. I don't want to drag the stream out too long today for you or this evening. So we're going to kind of race through the information hopefully you get a lot out of it. Excuse me. All right. First of all, let's take a look at LendingWorks. As you know, they are drawing down the loans to repay retail investors. They have released a Q1 2000, I think it's correct up to January. Sorry, not Q1. This would be considered, I guess, Q4, January 31st of 2023. They have a total outstanding amount of 13.1 million that if you are a LendingWorks investor, you'll probably be receiving little bits of money back and forth. Everything, I think, seems to be going to plan so far. We'll see on that. Out of all loans active, 0.52% of the outstanding borrowing has been paid by the Shield. 7,136 investors. Let's kind of read their performance and what's going on with the expected annual returns as they repay back. Apparently, I mean, things seem to be going okay over there, but they do expect to continue to pay the higher interest rates as far as their expected target rates go. Both expected annual returns and expected annual loss rates have remained broadly stable compared to our Q3 2022 update. Expected annual losses have been updated to reflect the most recent portfolio performance and the latest economic forecast provided by an independent third party. Overall expected annual losses on the active portfolio remain stable at 3.8% of Q4 2022. However, we will continue to monitor it closely due to the external economic environment. Expected annual returns have remained stable. Average returns on past cohorts are 4.4% per annum for growth, 3.8% per annum for flexible, and the 2020 and 2021 cohorts average returns are 2.5% per annum, 4.5% per annum for growth, flexible 4.0%. We will continue to pay at the target interest rate level for all cohorts. However, the expected annual losses on the active portfolio remain stable at 3.8%. So, not the best thing you want to read that there is going to be annual losses, but I've always said this, it's better to take a 3.8% loss than something much more severe that we've seen in other peer-to-peer lending companies that have not done so well. So while, yes, I would personally like to see a positive return back from LendingWorks, I'm happy just to get my money back if I take a couple of percent loss here and there. Not really too worried about it. I think a lot of these platforms that are performing badly are just going to wash through, and what we'll be left with will hopefully be strong, well-regulated peer-to-peer lending platforms, and all of this nonsense can be behind us. We'll see. Okay, we're going to look at the January 2023 Lend Invest figures that they released. There was 5 new investments in January 2023. Average return offered at 6.2%. Average loan to value 61%. Some stuff in Scotland mainly, it looks like. Northwest Midlands, Yorkshire, and the Southeast. Out of term, 18% of loans out of term, 5% in enforcement, 74% on schedule. Typical target returns 4.5 to 7%. Again, Lend Invest, not strictly peer-to-peer lending, but seems to be performing pretty well. I found this a very, very interesting article that I wanted to highlight today because we have seen, obviously, this kind of contraction of retail peer-to-peer lending companies. So there was this article entitled Retail Investors, the Birth of Retail Peer-to-Peer Lending. Retail lending in peer-to-peer is not dead, but it's evolving. Peer-to-peer lending was originally created for retail lenders. Multi-billion-pound industry was built around this, but over the last few years, institutional backing has become the norm, and it's tempted some big players to leave the retail marketplace. Plus, the challenging combination of economic instability, regulation, and rising costs have seen the original big three close their doors to retail. That'd be RateSetter, Funding Circle, and Zopa. Also, Assets Capital, ThinkCats, Landbay, and LendInvest have all shifted their business models away from retail towards institutional funding lines. Most recently, Archover announced it was leaving the retail peer-to-peer lending space due to higher costs. Now, this article also says that this could be generally seen as a negative play on the industry for the untrained eye. However, myself and also this article does believe that these actual contractions are really good for the industry, because what it's doing is kind of washing out the businesses that possibly were unable to survive long-term offering retail services because, number one, they'd become too big, they were not making enough money, and they were just unable to serve the retail market. So if you imagine a company as big as RateSetter that had literally hundreds of employees, they had high expenses, their margins were small. If you've ever been in the customer service business of servicing a lot of different clients, you know it can be a challenge, right? So imagine these companies are servicing hundreds, if not thousands of customers. They're getting phone calls, they're getting emails. It means they have to have a pretty big team just to respond to the customer service side of things and to keep their customers happy. Because we all know what happens if you don't receive responses back from a company where you have money invested in. It doesn't give you a lot of confidence. The problem for these companies like RateSetter is they just had such a large amount of staff that they had to keep on the payroll. Big expenses, hard to make a profit. So they go institutional funding. Same could be said for Zopa. It was more lucrative for them to go into the banking world. And it seems like Assets Capital has also gone the same way. Probably just not making enough money out of the retail side. Well, what happens when we get this contraction is people like you and I who are still interested in investing in peer-to-peer lending, we shifted to the other smaller companies that have provided good service, provided returns that have been stable even through the pandemic. So we see this contraction, and I believe a higher quality of investment service that has been provided by our companies like LoanPad or some of the other peer-to-peer companies that we enjoy talking about. Cufflink, Propland, Blend Network, Unbolted, Assets Exchange, possibly Easy Money, Lendwise. So there's a bunch of them. So while some of the media has reported very negative things about peer-to-peer lending, this contraction could be seen, actually, we look further into it, as a very positive thing. Now, what also this article says is that the peer-to-peer lending world is very interested in attracting younger investors, because younger investors don't really have much interest in investing their money in banks. Most of them have never even stepped into a bank. I mean, how many people really need to go into banks these days? They're doing everything online. I mean, some of these banks don't even have physical locations for people to be able to go to. So the younger generation is more used to technology and would be more apt to alternative financing places to put their money, like peer-to-peer lending, like places like cryptocurrency, because they're more open to those types of investment. So the peer-to-peer lending sector can reach those younger people, which I think they can. Requires education, but I think the sector will absolutely continue to thrive. Now, what was interesting about the article was talking about younger people and banking, and I was thinking, well, why do I continue to still invest money in peer-to-peer lending? I've been doing this since 2015. I've experienced some definite negative sides of it, from being, I wasn't one of the earliest adopters, but I was there through the poo-poo caca that happened with Lendy and all these companies that were probably acting, in a fraudulent manner and not in a manner that I would want to see a business act. So I've had some definite negatives to those. But one of the things that really makes me continue to invest money through peer-to-peer lending is, number one, I like to support small businesses. Some of these businesses are small businesses, they're privately owned, and they're, they have that way of just servicing, I think, differently. I would never have access to the Barclays CEO to have him come on the stream, or Chase, or Hargreaves Lansdown. They just don't give access. And these smaller companies, you have an ability to be able to speak, in most cases, to the guy that owns the company, just to find out, what's going on and make yourself more comfortable. Number two, I'm not a fan of the banks in any way. Banks are not here to put your best interests at heart. Believe that. They have one interest and one interest only, and that is profitability. Making your money turn into more money for them. That's what the banks are interested in. If that wasn't the case, they'd be paying you more interest. Remember, when you deposit money into a bank, that bank has no obligation to keep any money in reserves. They're going to take your money and they're going to lend it out for more than they're paying you. In some cases, a lot more than they're paying you, with no obligation and no rules in place. For every pound that you put into a savings account, they don't need to keep any part of that £1 in their reserves. So if there's a run on the bank, like there was in Iceland back during the economic meltdown in 2009 and 10, the banks wouldn't have enough money to pay you back. So I have no obligation, I feel morally, to really support banks. I see bank scandals coming up in the news all the time. Here's just a few of them here. FCA fines Santander, UK £107.7 million for repeated anti-laundering money failures affecting its business banking customers. So there's that. In the US fines 16 Wall Street firms $1.8 billion for talking deals and trades on personal apps. So insider trading, 100% going on. This includes Barclays, Bank of America, Citigroup, Goldman Sachs, Morgan Stanley. I mean, these banks they're just causing all kinds of issues that the regulators just keep slapping them on the hands. We got tons and tons of news articles here about UK watchdog finding banks all over the place over here. We have a massive Wells Fargo scandal that occurred in the U.S. here several years ago, and they were forced to pay $3.7 billion for illegal activity, including unjust foreclosures and vehicle repossessions, misapplying loan payments, incorrectly assessing fees and interest, and charging surprise overdraft fees. And then also Wells Fargo was fined $3 billion. There's long-running civil and criminal probes. Again, this is a huge U.S. bank. They basically were opening bank accounts for people that were not authorized. So if somebody went into a bank to inquire about a bank account and decided they didn't want to do it, Wells Fargo employees were opening up bank accounts because they were forced to reach certain goals as far as account opening. They were also aggressively cross-selling products to enhance sales and revenue to meet quotas. And stuff like this is going on. This is just the stuff that we know about, right? So when I read news stories like this, I just really don't have any feel that I want to support the banking industry in general. I know that they're not pure. And so peer-to-peer lending allows me a place that's more independent, smaller, to put money, to know I can invest, and not necessarily have to support the banks. Now, this article also talks about the difference between what interest rates on savings accounts are paying versus the risk that you take in peer-to-peer lending. There's a quote in here from somebody at Hargreaves Lansdown who was saying it's a tough sell if you can get 4.7% from a bank product to getting 5% in a peer-to-peer lending product. Now, I agree with that. There is a certain amount of truth to that. If we look at what you can actually get in an easy access account these days, you're talking about a little bit under 3% for instant access. You can actually get Chase Bank, one of the evil banks, for easy access. It is variable, so this amount can change, go down as interest rates do go down. But you can get yourself 3% on an easy access. Again, the question is, do you want to support the banking industry? Because you are making a vote with your money, and there is some moral choice that comes along with that. Now, if you want to get a fixed rate, you can get a 4.5% on a fixed rate term. If you're looking at 1 year, you can get 4.25% through Raisin. It's pretty attractive. Again, if you need access to your money, this is either you're not going to be able to get it, or you're going to face some penalties from that. If you're going to a place like LoanPad, being able to get 4% daily access or 5% on a premium, and you're looking at, well, I can get 3% through the bank. Is it really worth it? That's a perfectly reasonable question. I do like this 5% 60-day access product. I think this is a very attractive product. And remember, the difference between 3 and 4% is about 37%. So you're actually getting 37% more interest through a company like LoanPad than you are going and getting an easy access savings account. Are you taking 37% more risk? So it doesn't seem like a lot when you're talking, the difference between 2.9% to 4% savings account versus lower risk peer-to-peer lending, but it's a 37% difference. And if you go to a company like Easy Money that's paying 4.53% target rate per year, you're talking over a 50% difference between a savings account interest and peer-to-peer lending. Are you taking 50+% more risk by investing through Easy Money than you are through a FSCS protected savings account through one of the big banks like Ford or Chase Money or Marcus or Yorkshire Building Society? Personally, I don't think the risk is that much. I don't know if it's 50% higher. It's hard to quantify exactly how much more risk you are taking to get an extra point or 1.5%. So that's something you kind of have to figure out for yourself and say, is it worth it? I think what the answer is diversification, doing both. As much as I do not really like supporting the major banks because of the things that they do in the background, like insider trading, charging fees they shouldn't charge. I'm getting charged right now £8 a month for a Barclays business account. So basically my money's in the account and they're using my money to lend, right? And I'm paying them for the privilege of them using my money to lend. Is that really just? Is that a good way to take care of customers? I don't think so. It's also a lot of hassle for me to actually switch bank accounts because I'm not in the UK. Sometimes it can be challenging to do that. So I think the difference between 5% that I can get in LoanPad versus the 2.9 or 3% in the savings account is personally for me worth it. I don't think I'm taking 37% more risk through LoanPad than I am in the savings account. Again, my opinion. Back to the article. Cufflink is also talking about here, Narendra over there, how the next generation have never walked into a bank. Everything is done on an app. So I think as peer-to-peer lending evolves, gets better, they're going to have more app support, because I think that's something that is really not supported very well in the peer-to-peer lending sector. It talks about Plend in here, having more bespoke options for people. I think one of the challenges that the peer-to-peer lending sector is facing right now is how do they reach these new customers, because the FCA is kind of restrictive the way that they can advertise peer-to-peer lending. So that's definitely one of the problems. On the Dragon's Den recently, it talks about a peer-to-peer lending company that made a pitch. Just Lend was on there, and how when that episode aired, there was a lot of Google searches for peer-to-peer lending and also for Just Lend. So I think that as the industry really starts to get through this difficult time that it's had over the last 3 years with some of those company failures, which certainly hasn't made things easy for the sector, that it will really start to thrive forward and become a little bit more in the light of, and at the forefront of people's minds. I think it's kind of shrunk, as these negative things have happened. The sector's kind of shrunk a little bit as far as its exposure to new people. The returns have been stable. They're there in most cases, not all. We've had some situations, like Assets Capital, where the returns haven't been good. Also, lending works and things like that. But I think over the next 2-3 years, you're going to see peer-to-peer in more of a generally well-received limelight in the public as these companies try to reach new customers. I thought it was a very, very interesting quote here from Narinder at Cufflink saying, "We've been talking to institutional funders and they all ask if and when we take institutional funding, do you intend to close down your retail platform? Some even ask for priority on loans. For us at Cufflink, the answer has always been no. Couture believes that institutional retail funding can complement each other. In fact, retail money is often the more attractive prospect. You can grow a business and be profitable by doing pure peer-to-peer. The challenge you have with an institutional facility is if something happens in the marketplace, they can instantly stop lending, which in retail is less. Whereas retail is more sticky." So that's a really good point. If a peer-to-peer lending company gets in bed with, say, a company that's huge like Chase Bank is providing that funding. If something happens, Chase Bank can cut that funding, and then that peer-to-peer lending company can be absolutely stuck. Whereas retail, that money's coming from hundreds or not, if not thousands of different places. So if one lender isn't lending, you've got thousands of others that are. So when you put your faith and reliance on an institution, they pretty much control everything. And I think a lot of the theory behind peer-to-peer lending is you don't want to have that control by a big corporation that could really hold your business. And I think diversification for funding sources for peer-to-peer lending is very important. So I thought it was a really interesting article, and I just sort of wanted to highlight the personal reasons why I've continued to keep my money in peer-to-peer lending. And one of those is definitely because of the UK and the US bank scandals that keep coming up, and how I just really don't support what the banking industry is doing. There's a lot of corrupt stuff happening behind the scenes that these banks keep on getting fined by huge fines, billions of pounds fines because of the things that they're doing wrong. And I don't necessarily want to support that as a retail person. So very, very interesting. We talked about the interest rates. There was an interesting article saying rising base rates poses challenges for the peer-to-peer lending firms. So Bank of England, with the rate being at 3.5% base rate, can companies like LoanPad with their 4% continue to be an attractive place? I think they can. I really do, because they've got a good track record. And plus, very important thing, you can get daily interest paid. You're never going to get that through the bank. I'm actually surprised that no bank has started doing daily interest. That would be a really attractive feature. So LoanPad is one of the few, if not the only one that I know of, that pays daily interest. That's a big deal for people that are looking for income, even if it's in small forms. They can get their money out, and when you take your money out daily, you're actually reducing the risk because you can start to pay down that amount of capital that you have invested as your original loan amount. Whereas some banks, or companies that are paying you once every month, once every year, the risk is then higher because you're only able to get an interest payment once a year or once a month. What else? Let's talk about what's going on with consumer borrowing. It is up 17% due to the cost of living. The number of adults in Great Britain have borrowed via loans and credit cards due to the increased cost of living, and that number has increased the number of borrowers by 17%. The data from the Office of National Statistics reveal that more than a fifth of adults in the UK, which equates to 22%, or around 11.5 million people, have reported borrowing more money or using more credits in the previous year. We all know why this is happening. Cost of living has gone up greatly. It's very sad. This also reports here that nearly a third of those surveys said they would be unable to afford an unexpected expense, and those borrowing more were likely to report a high anxiety score. There has been a large increase in energy bills, people falling in arrears with their loan payments. Around 6% of adults say they were behind on their gas and electricity bills between 25th of January and the 5th of February 2023, which is about the same amount that were behind in March of 2022. However, half of all adults who have gas or electricity supplied to their home said they found it somewhat or very difficult to afford their bills in January and February. This is a very, very sad situation. We see that the UK inflation rates, which came out last week, are still very, very high. This is not a victory for the UK government. From December, they were 10.5% inflation. Now it dropped to 10.05%. Exactly what I thought was going to happen. Same thing happening in the US. Inflation rate seems to be cooling about 0.5% a month, but it really isn't enough at this rate. It's going to take 10 months to a year for inflation to cool back down to 5%, if that is even possible. If we see from January of 2021, when inflation was 0.7%, what a massive, massive increase. And this all spells trouble for the economy, being that we know we're pretty much in recession, and also for the stock market. The stock market has been absolutely bipolar because of what is going on with interest rates and what's going on with inflation. In the U.S., a report came out today, and again, this is really, I think we can see what the U.S. does, just kind of trickles down to the U.K. It kind of gives us an overlook of what's happening in the future. We have Federal Reserve minutes showing that the members of the Fed are resolved to keep fighting inflation with rate hikes. So that could mean that we'll continue to see more interest rate rises in the U.S., which will then trickle, I believe, into the U.K., with them following suit with the Bank of England going up. That's going to put a lot more hardships again on people. I mean, mortgages are now becoming increasingly expensive. It's putting a big cooling on the property market, trying to really slow the money supply down, and that's just going to hurt average human beings like you and me out there. Inflation remains well above the U.S. Fed's 2% target. I mean, I don't see that they're going to get that down anywhere close to 2%. I think I'd be lucky to get it down to 5% in the next year. So what is going on in the stock market? Well, again, bipolar actions. Even if we look at the trading 212 portfolio, we're now down to 17,471 pounds. So we've seen almost a $2,000 retrace backwards on this portfolio. Things are really struggling. We've got this Calera stock, which is just kind of all over the place, keeps on going up and down and up and down, and doesn't know what it wants to do. Some of the energy stocks struggling. Synovus down 5%. Ceres Power, this was up over 15% not long ago, is now up 7%, so still in the green. Even Deutsche Bank, solid solid bank stock, down almost 4% in a month. Flex Natural Gas is doing pretty good, up 1%, but it's not a massive makeup of the portfolio. Calera down 16%. Again, high risk, high reward stock. It is what it is. Walt Disney just practically broken even, and then Zim, our high paying dividend stock, at 7%. So it's just really a difficult time in the markets. I would not be surprised if we see maybe just a really flat year, maybe a loss this year. Wouldn't surprise me at all. And also I wanted to kind of just take a look at how things are faring with the trackers, because I still get these emails about, should I be investing in the FTSE 100 right now? The U.S. market doesn't seem to be doing very well, but the FTSE seems to be doing okay. Let's have a look. Is it doing okay? Year to date, we're up 4.6% on the FTSE. In the 1 year, up 9%. So yes, short term, looks like it's performing pretty well. We look at it to the S&P 500. Year to date, around 5%, so pretty good. 1 year, negative 5%. So the FTSE is looking pretty good compared to it. So I wanted to just take a look and see how things are for, we're going to go back to 2016 here and just plug some numbers in so you could see. And again, the history does not guarantee anything for the future. In fact, I'm less sure about historical happenings because everything is so weird in the economy right now. Talked about cars before, how motor vehicles have held their value for the last 3 or 4 years, and that's kind of unprecedented. Nobody would have thought that a car could be worth more today than it was 4 years ago. That doesn't make any economic sense, but yet that has happened in some cases. So maybe now the thing is to think about history is not necessarily a prediction of the future. However, it's the only thing we can go on, because that's all we have is historical prices. So for anybody out there that is wondering, should I be in the FTSE 100 tracker? Should I be in a global tracker? Should I be in a bond tracker? Here's some numbers for you to look at. I went to 2016 because that's when Vanguard released its global bond tracker and its global equity tracker, so I couldn't track it back any further than that. Just because, that's given us 6 years. Yes, it's not 7 years. Not really quite long enough. I like to go back 10, 15, 20 years to really zoom out and show you this. But this is what I got for you today, 7 years. And you can see right here, the FTSE started at 99 in 2016. Right now is at 147. If you wanted to take a more safer option that some people believe is more safe, we're talking about a bond. So we have global bond index tracker in 2016. This Vanguard global bond tracker was at £143. It's actually lost value today in 2023. It's now £140. So the reason is when interest rates rise, global bond trackers prices, they tend to go negative. There was a year when the global bond tracker had a good year between 19 and 20. This again, interest rates were low. So we saw it go from 2018 to 2020. So we saw it go from 146 to 149. Then we had that big jump to 161. But as long as interest rates stay high, these bond trackers are not going to do well. I ditched mine, I think about 1.5 years ago. But it is going to be more stable. If there is a market reverse or a market collapse, you're not going to see those big negative pullbacks and drawdowns in a bond tracker like you are in an individual stock or in an index tracker for stocks either. So it could be a place if you feel that you're really wondering what the heck's going to happen to the economy and the stock market, again, diversification might not be such a bad play. And then we can look at the global index tracker. This is this dark green number down here. It's kind of just been sort of middling around, but it's performed definitely better than the FTSE tracker. The global equity in 2016 was at £101. Today, valued at 175. I'll show you the percentages in a minute. But you can see by far here this increase in the US Vanguard tracker has just been night and day better than any of these other trackers. So, if you are considering about what you want to invest in, just zoom out and try to go back. You want to go back further than 2016. I think if you do go back further, you're going to see these numbers are pretty much accurate as far as the amount of increases you've gotten through each fund, and the US tracker's done really well. But if we look from 2016, I don't know why I decided to use a snowman here, but it looked cute. So this is US versus global versus the FTSE 100 versus the bond. Yes, and I know the bond fund shouldn't be compared to the equity tracker. I understand that. I just wanted to put it in here just so you could see, if you're somebody that thinks bonds are a good place to invest, I wanted you to see the difference in these numbers. So you got the US equity tracker up 162%. This is the accumulation fund. This is a linear increase from 2016 to 2023. It's not an IRR, investment rate of return amount. It's just a straight up, how much has it gone up from 2016 to 2023? 162%. I misspelled global here because she was kind of rushing around today. Global equity index tracker plus 62%. FTSE plus 48%. Not bad. If you compare these two numbers, they're not bad. And then the global bond tracker that actually is minus 2% lower than it was 7 years ago. So, not really a great result. And none of these funds are really going to pay you good distributions on dividend. If you take the income on the index fund, on the US equity index fund, you're only going to get 1.24% yield as a form of a dividend, so really negligible. If you're not in an ISA, you're going to pay tax on that, so it's not really great. In the accumulation, you are going to be paid 1.23% yield on the fund. Let's take a look at the FTSE 100, how much that pays. 3.5%, 3.45%, you're going to get a better yield on the FTSE 100. And in the income, 3.58%. The difference is the diversification is not really there. You've only got 102 stocks in the FTSE 100. I'm not sure why there's 102. I thought it would be 100. But you have less diversification. See the bigger stocks that make up the top of the index. Pretty big in the FTSE. You can look at what it's made up of. Shell, 8% of the whole fund. AstraZeneca, 7%. HSBC, 5%. So you see a pretty big chunk, especially Shell, making up 8% of the entire index. So if Shell has a really bad earnings report and Shell's stock price goes down, it is going to affect this fund. Not terribly, but it is definitely going to affect it. So we look at the global fund, you're going to get 1.72% yield. Not terrible, not great. And then, see, did I do the, oh, sorry. Yeah, and then the global index fund, this one isn't even paying much at all, 1.72% on the distributions for the global index. I think I read that out wrong. And then FTSE, the equity index, 1.73%. Yeah, I don't know. It's, I mean, personally, what I think is what I would, what I continue to do is just kind of stick to the plan of action that I've stuck to since I started doing this many years ago. Was just stick with the U.S. equity fund. Again, I don't think the the global fund is a bad play. There's a lot of people that say the global will do better than the US in the upcoming year or a couple of years. But again, nobody knows. I mean, that's the truth. Nobody knows what the heck any of these funds are going to do, what these stocks are going to do. I mean, these stocks could crash tomorrow. Nobody has a crystal ball that actually works and does anything. So I think it's important just to kind of stick to your game plan. No matter what the markets are doing, obviously you do have to watch for changes, but if you're doing index trackers and equity trackers, you can pretty much just stick to that game plan for the next 20 years, however long as your timeline, and know that chances are it's going to be worth more than it was 20 years ago. So that's my best advice. This type of investing through individual stocks is a roller coaster. I don't have the stomach for this. I'm afraid to turn on this portfolio one day and see this number down at 15 or 11,000. You know, do I think it's going to happen? Unlikely going to go down that much, but you know, these are real numbers right now, and you got to have an emotional steel stomach to be able to look at a stock that's risky like this Ginkgo Bioworks and see that you're down 38%, or Calera that you're down 16%. This can happen in one day. I mean, there's been days where Calera has gone up 25% in a day, right here. Let's see, there was one day when, so yeah, this day, well, you can see right here from January 30th to February 2nd, 26, basically a 26% jump. Here in just a 2-day period, $1.10 up to $1.20 in just basically 36 hours. You got to have the stomach for it. I don't necessarily, but I do it for the information and educational value for this channel, and to try to eke out some good returns. I mean, this portfolio has done well, but and to give money away to charity too from this, which I haven't been able to do this year because I haven't made any money off it. I'm in the negative, but we'll see. Stick to your plan anyway. Basically, that's the message. Whatever your plan is, come up with a good plan and stick to it. I think you'll be okay. All right. Yeah, if you can hit that thumbs up, I would really appreciate, Holly would appreciate it too. She's having a little snooze over there. Apologies for the buffering, if it's buffering. Richard said the extra risks on peer-to-peer instant access is around 15 to 20% a year extra per 1,000 invested. How do you quantify that? How do you quantify 15 to 20%? I don't know that there's a way to really quantify the additional risk amount. I think it's really about personally what you're willing to risk. I do like the instant access of non-guarantee, of course. And I think that's something that's been a big positive for me personally, is knowing that I can possibly get the money out if I need to. Until I decide how 2023 is going to pan out in this recessionary climate. Yeah, it's good. I don't know what's going to happen. Everything is pointing to disaster at the moment. High interest rates, high inflation. That's a liquid nitrogen bomb ready to go off. Mention of liquidity issues. You know, I would argue that banks have liquidity issues, right? If there's a run on banks, they're going to have liquidity issues too. Yes, the governments might bail them out. We'll see. I don't think there's any way that inflation goes lower than 5% by the end of this year. Hello, Aki Chap. Nice to see you. The S&P is not doing well. That's the time to buy. Yep. When there's blood on the streets, that's when you should buy. Gutted that I had to give up my U.S. equity tracker with Vanguard. You should be able to buy an ETF, though, Annabelle, no matter where you live. They have ETFs that are, I think Vanguard has a, look up VTI, which is the US version of the equity tracker. I don't know if you can buy that in Spain, but there is an ETF version. It's the same as a tracker. It just means you can sell it quickly versus index trackers take 24 hours to sell. Good evening. I would appreciate it if you could look at capital stackers who offer high interest. I'm really keen to know your thoughts. Okay, I'll tell you what, next Thursday, you can put it on your calendar. I will do a little analysis of capital stackers and see what I think. So come back next week. Okay, how long have we been going for? 3:21. I think that's perfect. Listen, I'm going to get out of here. You guys are great. As also, always, I appreciate you being here. Sorry for the coughing. It is what it is. Love to you all. I'll be back next Thursday with her too, hopefully. All being well. And have a wonderful weekend. Enjoy the cold weather. Don't worry too much about money. And yeah, I hope you really enjoy your weekend. I do. I appreciate you being here. I'll see you later. See you next Thursday. Take care. Bye.